SpartanNash Company.
Okay, as soon as I saw food distributor, I thought low profit margin.
Well, food distribution's getting, tattooed chef is up there. Like, this is getting to be a thing now. I'm not surprised someone wanted to see this. And what I see is a very low stock price, not number, but maybe in comparison to what it used to be, not very low, but I mean, it's definitely down. So I'm interested in, I guess you've trained me to maybe look at more companies that are more down, right? We don't want to look at them as they're flying up. We want to look at them as when they're kind of down.
Right. So they're a multi-regional grocery distributor and retailer, operates in the United States, segmented into military, food distribution, and retail. Its military segment consists of distribution of products to the U.S. military commissaries. Okay.
What is the market cap for this company, baby?
$600 million. So it's one of the smaller companies we've looked at.
600 mil, okay.
Yep, but PE ratio, 8.7. Check mark there.
Okay, PE check mark. How about profit margin, Paul?
Okay, profit margin's awful, 1%.
Oh, Lord.
Yeah, and in the last 12 months, it's even lower than that. It's like 0.75%. So the X there has a big dividend. So 4.5% dividend on $600 million. You're looking at $27 million in dividends per, did I do that right? 1%? Yeah, around $27 million in dividends per year. So we have a check mark and an X, and we have $27 million in free cash flow that we need to be able to get to pay that dividend. Because free cash flow, one of the uses is paying out dividends.
Let's look at, sorry, Paul.
Revenue growth.
Revenue growth. Thank you. Pillar number 3, revenue growth.
Okay, 7.65, 8.5. Check mark.
Nice. Alkali's saying they do stem cell research as well. That's
strange.
Okay. Keep going, Paul. Let's go profit growth over the past 5 years.
X. 62 to 5.7. But that's interesting. That was 2019. I wonder why that happened. Because they were, I mean, look at this. They did 63, 50, 57. They lost 53, made 35. So it's inconsistent. So guys, when we talk about inconsistency, it's really important, in my opinion, that when profit is inconsistent, you pay a much lower multiple of cash flow and PE because you don't know what you're going to get here and there. It could be 1 year you have a $57 million gain, you give it all back the next year. So in 2 years, you made no money.
This is SpartanNash, which is American food distributor and grocery store headquartered in Michigan. Paul, keep going on your pillars there. This is pillar number, I have no clue. I lost track.
37 million shares. Those are 35. So check mark there on pillar number 5.
Pillar number 5 is check mark. So they're buying back shares?
They're buying back shares.
Oh, that's nice. Okay. How about pillar number 6, which is current assets greater than current liabilities?
So the current assets are 1.1 billion. Current liabilities, 695 million. Check mark there.
Oh, nice.
And they only have 1.6 in total liabilities, which is good because a low profit margin business, it's hard to have a lot of debt in there.
Let's look at free cash flow. This is the free cash flow growth, cash from operations minus capital expenditures over the past 5 years. We're going to get an average of this.
Okay, so it was 142, and last year it was 105. So X for growth.
Oh, boy.
And the average is 80. So 83 is one, negative 22, and 100.
Negative 22. Oh, my gosh. Oh, my gosh.
So this is the inconsistency I talk about, guys.
Plus 105 minus 22 divided by 5 is 81. 81 is their free cash flow.
81. I hate to say this, guys, but
come on.
I mean, this actually doesn't look bad. You're basically paying 8 times free cash flow for the company right now.
Market cap is 600 million.
Yeah, you're basically paying less than 8 times free cash flow. I mean, let's look at their last 12. I mean, this is 2 in a row now that have hit our metrics. But here are the concerns I have with this company.
Okay, go on.
Well, first of all, let's see the trailing 12 months free cash flow. Oh, about 190 million. Wow. I don't like the low profit margin. Low profit margins just eke me out. Let's look at this. This is my Excel sheet that we're going to input into the Everything Money and 8 Pillars app. It'll allow you to put your inputs in here. Right now, the average profit margin of the last 5 years for them has been 0.2%. It's a very, now my metric says it's worth about what it's selling for today. I'll be honest with you guys. I hate to say this. Even though all the metrics hit, I'm apprehensive about this because of this profit margin. I just hate this profit margin being so low. But that free cash flow is pretty awesome. That free cash flow is really awesome. Let's see here. Trailing 12 months.
Make sure you guys are smashing that thumbs up. We love you. And someone did smash thumbs down. We appreciate that as well. It must be because my camera crop could be adjusted a smidge. Look at this headspace, Paul. It's killing me.
Seems like they have free cash flow the free cash flow is solid. We've got to do more research to understand what's going on with the military part. I'm not a huge fan myself personally in investing in something that relies on the government. Because at any given time, like Biden's coming to office now, Democrats tend to be less on military, less spending on military. Whether that's going to happen, I don't know. So you always worry about companies like this. What percentage of their revenue comes from the military when they're restructuring, et cetera? Now, does this mean you wouldn't buy a small number of shares and build on it as they get better? Yeah, maybe so. For me, for my personal opinion, I'm probably not buying this company because of the reliance on military and that low profit margin. That's my opinion.